Ron is here, and we are talking about results that we saw coming through yesterday. Ron, you particularly like cash build.
I think.
Has that anything to do with his being Irish or what? And it did St. Patrick's Day yesterday.
Yes. No, they've really had a good track record, consistent track record. They've spewed a lot of cash out. The management is very well versed, very well skilled. They've been there for a long time. They've built that operation. They've expanded their geographical footprint. Unfortunately, in times like this, the industry's become very competitive. They do spend 90% of revenue comes from cash. The other 10% comes from credit, which is provided by Nedbank, so there's no recourse to cash bill. We've also had deflation in a number of the products that they sell as well, there, Godfrey. But to me, in terms of when the economy turns around, the World Cup is over, spending priorities will go back to clinics, go back to housing, go back to schools and stuff like that. And in the rural areas where cash build is very strong indeed, they will then start on the upswing. The one aspect which was a little bit worrying, obviously, it looks like they were trying to keep market share. We saw top-line revenue growing, I think it was about 7-8% but expenses grew at 14%. Right. The big bulk of that was people costs. So that's a little bit of a worrying sort of aspect.
So there's keeping capacity, perhaps anticipating an upswing and therefore keeping that capacity so when the recovery comes, they can run with it.
As they said, it's not easy to replace skilled people, people that are dedicated, been with Cashbill for a long time. So their policy certainly is not to retrench at this point in time.
But in terms of maintaining the margin, were you satisfied with the efforts that they've undertaken in this half to try and keep costs down while, of course, as we said, maintaining that capacity?
That's a little bit worrying there, Godfrey. Obviously, as the economy starts picking up, and we're seeing the first signs of that then, I think we will see some growth in top-line revenue coming. As long as that can grow at a faster pace and perhaps some sort of cut in expenses, then we will see profitability coming to the bottom line. I think the bottom line is down about 27 odd percent.
Yeah, but Cashbuild was in a far better space than Iliad. We also saw Iliad yesterday reporting results, headline earnings down 70% if I remember correctly. And we're seeing they're dealing with the same sort of kind of issues, but very different results.
Different market profile as well. Low end of the market, cash build in the rural areas, bucky builders and the like, big customers of theirs. Whereas in the case of Iliad, you're quite right, the 70% is a function of that middle market where people did have credit cards, they're trying to get out of debt. That low end of the market doesn't have credit cards. Big difference. Guys are not spending money on refurnishing. That middle segment of the market is paying down credit cards, paying down debt, and there isn't a confidence yet to go and do some major renovations and the like.
So Ron, would you be touching any of those stocks at these levels?
I would be buying cash build into weakness, superb track record, and again, government spend at that bottom end of the market, social security and the like. I still think that's the one to be going for.
Would you be looking at Avenge with an order book up 8%, 32.7 billion rand, even as contracts related to the World Cup came to an end?
Godfrey, I'm just a little bit worried about the steel side. The Trident steel and the steel fabrication side of the business seems to be under a lot of pressure. The explanation given at the presentation yesterday, I found just really wasn't satisfying. The company is very strong with a net cash position of 3.2 odd billion after taking off the guarantees for bonds and the like. Grinica LTA in South Africa has turned around very nicely with better margins. The Australian operation, the margins were down. We saw some losses on some more risky business like pipelines. I'd like to wait. I don't think the timing is quite right to look at Avenge there. I think maybe there are better opportunities in the market.
Yeah, but in terms of Avenge and the kind of competition issues that it is facing in the South African industry, the quality of that order book, would you say it has deteriorated? Are they maintaining the quality of the order book?
I think the days of the big fat margins in terms of Soccer City and those sort of contracts are over. I think, as was said yesterday, margins will continue to come under pressure. So they've got to become more and more efficient. They do have a nice cash pile or a nice war chest. They save for opportunities. We're really not too sure what those opportunities are going to be.
For most of those builders, we're seeing price to earnings ratios below the 10s. And when we compare where they've come from, sure, they've come down very hard indeed. Some value in there?
I think the value is in there maybe on a 2 or 3 year view. Ultimately, in terms of the 800 odd billion in terms of government infrastructure spend, sometime we must see that thing being kick-started. Perhaps we'll see some turnaround after the World Cup.